Hi, Steve Van Metre here, and welcome to your weekly economic update where we take a deeper dive in the economic data to try to see if things make any sense. And they don't, but we still try anyways. And I feel like I've got a million things to talk about today because we had two interesting things going on this week. We obviously have the trade war, and then we have the move up in interest rates. And I know everyone's going to panic a little bit. And just like they panicked when I said interest rates were not going to 5 or 6%, and now they went back down to the all-time lows, I am going to be right again, and I'm going to show you very specifically why at this point you'd much rather own bonds than just about anything else. I know, it sounds hard to believe, but just about anything else. Let's talk about the trade war real quick. Of course, the markets hyped this up that we're going to have a big, giant trade deal. And I knew we weren't, because it was really, really simple. In advance of sending their delegation over to the United States, China did not grant Vice Premier He special envoy status. Now, in China, unlike the United States, only President Xi can negotiate trade deals. He can pass that ability on to somebody, but he didn't. Of course, the question then becomes, well, did the Trump administration know that? Well, if I knew it, of course they knew it. I mean, it's not secret. I don't have friends in China that are in the government that tell me this. It's public information. It didn't make the news because that would not actually help get people to buy stocks. Remember, the big players want retail investors to buy stocks at the peak so they can sell them. And how do you get people to buy stocks at the peak? You tell them there's a big, giant trade deal coming. Of course, it also helped that President Trump tweeted that as well. And people buy stocks and the big players sell, because what did they know that I knew that you knew if you read my Facebook post? That they couldn't negotiate a deal. They couldn't sign anything. He was not granted the ability to sign anything. And so what was the objective of the Chinese delegation? It was really simple. It was to get President Trump to not put the tariffs on Tuesday. They were going to go from 25 to 30%, and it worked. And all they had to do was agree tentatively. Mind you, there's no agreement. Nothing has been signed. The earliest this could be signed is 3 weeks from now, and nothing has been written. Do you feel bamboozled a little bit? You should, because I have a hunch that we as a country are going to get bamboozled again. This isn't the first time we've gotten deals like this and had promises that never happened. The vice premier's job was to prevent those tariffs from being increased. That was his role. And he did it. And I tip my hat to him, because all he had to do for the most part was agree to buy more U.S. soybeans and U.S. pork products. Mind you, China has been buying both, and they need both because they're short both, and they can't get it elsewhere. So really all they had to do was agree to that. Now, what you also probably didn't hear in the news is that China, hours before the meeting with President Trump and Vice Premier He, said, we have a list of companies, U.S. companies, that might get on our bad list, which means we're going to sanction them. That's a nice way of saying it. They have a really nice wording for this that says, if this list gets mysteriously published and your name is on it, you're in trouble. We're going to make doing business in China hell for you. And all they did was threaten to release that list. Nobody even knows if the list was real. It actually was finished allegedly today. And magically, there go the tariffs. China's going to keep buying more products. Whether they do or don't, we don't know. And in 3 weeks, there'll be something written, and President Trump and Xi are, I think, scheduled to meet in Santiago. Anyways, I don't know the details on that. But there you go. The market got all bulled up over nothing. Absolutely nothing changed today. Nothing. All this hype and nothing changed. So now that you've got briefed on that, let's talk about the bond market. The content of this video provides educational information only. Is not intended to provide investment or other advice. This channel is not to be construed as recommendation or solicited to buy or selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video or that of my own do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial. I feel it necessary to mention this because we've been picking up some new viewers off of YouTube. and Facebook, and for some reason they think this is their personal trading channel where they can email me or message me, ask for trading advice, position advice. It's not what this is. This video is prepared for my clients, and if you just heard the disclosure, and if you didn't, it's linked in the description below. I'm not here to provide information on any of this. This is a research, and you should treat it as research and seek to find other people with my view and people that are opposing my view, but you should not make any trades based on anything you hear. If you do and you lose, I and my firm are not liable. So keep that in mind. This is a research video. Okay, I want to, for my clients, I'm sorry you had to hear that, but it's just been what's going on. I'm like I said, I'm happy we're getting new people watching. They seem to appreciate it, but for some reason they think I am here at their disposal. Let's go through the charts real quick, and then we'll get into the bond stuff. You know what? No, we'll come back to that. Okay, so as everybody knows, I rebalanced the portfolios a week ago yesterday. I said we're going to take more risk because the bond market is on the edge of a bull market. Okay, here's how you trade bull markets just in general. Let's start with stocks. When stocks rise, start to pass their prior bull market peak, you buy. You just buy. And what do you buy? You buy whatever's going up. Doesn't matter. You just buy. Because stocks go up they go up really slowly, year after year after year. Bonds are different. When bonds enter a bull market, they literally do, and I've shown you this, we could look at it again today, they go like this. And they do it really quick. So stocks, you're talking 5 or 6 years. Bonds, you're talking a month. There's a difference between a bull market and stocks and bonds. When you're trying to trade that or invest a bull market breakout in bonds, it's extremely difficult. Even professional traders who have been in the business 30 years will tell you, if you miss the bull market move in bonds, don't chase it. You will get slaughtered. Because here's what happens. They go, remember, because what happens up here? All the big players dump. And then it just literally collapses. And so it can move very, very quickly against you. And so unlike stocks where you wait until it breaks out, if you're totally nervous and like, I'm not sure this is a bull market, you wait till it breaks prior all-time high and then you buy. And then you hope you know when to get out, and most people don't. When it comes to bonds, you have to buy ahead of the move. It's the only thing you can do. Because if you get that move, and you sell remotely near the top, which is not actually that hard to figure out, you make a lot of money you can make an equity-like return in about a month, maybe a month and a half, that would take other investors 3, 4, 5 years to do. Is that worth the risk? Yeah. But you have to be prepared for it to do some up and down moves. I knew that could happen. I said that was going to happen. I didn't want it to happen, but it did. Now, why did it happen today or this week? And I'm going to show you in the data when we get to it. The Fed ended up announcing QE, I'm not even calling it quantitative easing 4. And I hesitate to call it that because I don't know what their official term is. They announced it today. In fact, let me just show it to you. Let me pull that up. Here. So they announced quantitative easing 4. You'll see down here, blah, blah. Where is the $60 billion per month? Here, in light of they're going to buy treasury bills, so short-term treasuries through second quarter, maybe longer. And somewhere in here, I don't know where it says 60 billion, but it does. Somewhere, if not in here, they did publicly announce it. It's not jumping out at me, but they did say it was going to be 60 billion. Now, from a bond perspective, you might think, oh no, that's really bad. Interest rates are going to go up because that's how they did in quantitative easing. And if you think that, bingo. That's exactly what the smart money wanted you to think. See, smart money knows monetary policy. They know monetary policy and they know the lags of it. And you know what most investors, professional or otherwise, have no clue about? The monetary lags. They don't know what it means. They don't. And I've literally spent a lot of time studying this. I still don't know it perfectly, but I know it like far more than most people. Far more. I mean, there are people in business for 30 years. I read there's something like, God, they don't even, I have to stop reading because they don't understand. They don't get it. So what do investors believe? When you hear the word QE, what things should happen? Stock prices should go up and bond prices should go down. So the banks knew this because the Fed is major shareholders are the big banks, and the Fed's going to buy stuff from the banks. They got to talk to the banks before they do anything to make sure everything's cool. Banks knew. That's why they're smart money. They know before we know. So what did the banks need to do? They needed to make the market look just like you would think it looks. They needed stocks to go up, and they needed bonds to go down. Doesn't mean perpetually. It just means, you hear the announcement today. Fed announces next, $60 billion of asset purchases through treasury bills through second quarter. And when you look at the charts, go, stocks are up, bonds are down. People knew. Validation. But the monetary lags don't work that way. It's not an instantaneous response. It's an 18-month minimum. But the banks made it look like it happened today, and they did that very specifically. Since the great financial crisis, the financial system in our country has changed to the extent of which I cannot fully explain to you because I don't understand it as well as literally one person I have found that actually understands it. And everyone that knows this guy always like, yeah, I don't get it, but he understands it. And if he says that's how it works, it's how it works. And he says that banks are desperate for collateral. They are financially not as strong as everybody appears, as they appear. And what do they want? They want treasury bonds and mortgage-backed securities. Why? Because they need them during the recession. And so if everyone thinks there's QE coming and they think interest rates are going to go down or up, what are they going to do? They're going to sell their bonds. And who wants to buy them? The big commercial banks. And I'm going to show you in the data how the banks knowing that, actually sold about $8 billion or $9 billion versus treasuries toward the end of last week to make interest rates go up. So people would believe that's what should happen. And then we'll probably see in the data next week that they turn around and bought. And I didn't tell you how many mortgage-backed securities they bought. They bought a boatload of those. But let's go back to this now. Principal payments from agency debt and agency mortgage-backed securities up to $20 billion per month will continue to be reinvested in Treasury securities. What that means is the Fed is still dumping its mortgage bond portfolio. And when the Fed sells mortgages, the bank is buying. I actually did the math. The banks are literally almost buying every one of them. Now, some of those are being sold off into the market, but almost every, and we're talking, the Fed's selling $20 billion a month, the banks are buying 18.5. I mean, at that point, what's 1.5 billion? Nothing. So when the Fed sells long-term bonds, long-term interest rates go down. Okay? I'll show you. Here's the data. Mortgage-backed securities. The Fed bought 13 billion of them last week. Feeling bamboozled a little? Here we can look. They've been buying clockwork, almost 20 billion a month. Now let's go and look at the chart. You can see on a year-over-year basis, they're rising. The number of mortgage-backed securities is rising. Look here at 30-year yields. They're lagging. They need to go up. They need to go higher. I'll give you some more evidence if you're not sold on that. Here, let's go look at 30-year Treasury yields. The data that we are looking on that spreadsheet go back to September. So let's say you if you've really understood this and you started buying long-term treasuries or mortgage-backed securities back in September of 2018. Let's move this up so you can see it. Here, you made a bunch of money. That's what happened. Interest rates went down because when the Fed sells long-term bonds, interest rates go down. They just put on there They're going to continue doing that. That is their press release from today. Now, you said, well, I don't get it. These are the bonds, these are the mortgages that the banks didn't want from the great financial crisis. This is the trash that the Fed bought because of the great financial crisis. So the banks have to buy it because there's no market for it. Do they want it? No. But they have no choice. You can see out of $20 billion a month, they're able to offload $1.5 billion. That's nothing. Not even 10%. These aren't the good mortgages. If you've done a mortgage lately, you know that the conditions to get one are much tighter. Now, I get involved from time to time when a client needs a mortgage, they need statements, and sometimes I need to talk to the lender and explain whatever's going on. Conditions are tight. I've had deals that were to happen fall through, and then we a couple months later do it again because something wasn't right. It's not like it used to be. Fog and mirror. Oh yeah, here's your mortgage. In fact, if you didn't, I'll find someone else here. They'll sign for you. Here's your mortgage. It's not that way anymore. And at the end of a long economic expansion, do you think this is when you get the good mortgages or the bad mortgages? It's when you get the bad ones, because all the people that wanted a house bought one. I'll give you a perfect example. My stepson sells cars. And he used to sell cars for Chevrolet. He now sells cars over at Audi. So if you're looking for an Audi, go find him. A really nice kid. When he was selling cars for Chevrolet, at both dealerships, he's what you call a floor salesman. And that means if you do not have a relationship with the dealership already and you walk in off the street onto the floor, you get him or someone like him. He's a floor salesman. He doesn't work the phones. He doesn't get leased leads. His primary job is to work with anybody who walks on the dealership lot. Now, while he was working for Chevrolet, which is everyone that knows here, sells cars of all ranges, from very, very inexpensive cars to more expensive cars and trucks. Do you take a guess what the average credit score of the client he worked with? Now, mind you, every once in a while, yes, someone would walk in and say, hey, I'll take that Cadillac and I got cash. Sure, that happened. Every once in a while, someone came in to have their car repaired and needed to buy a new one. They had some decent credit. But do you know what the typical credit score of the person he would work with was? Take a guess. The top end's 1,200. You think it's 800? No. Maybe 5 or 6? It was 400. He said, man, I saw more 400 credit scores than I ever thought existed. So in the mortgage world, when you get this late cycle stuff going on, not only are the banks being forced to chomp down all of the garbage mortgages they sold the Fed to begin with, but most of the loans they're getting right now are garbage loans. And guess what they have to do? They have to reinsure against them. So they're not out trying to get a bunch of loans because guess what the majority of them are? Bad. They don't want these low credit score loans. Because guess what happened? Do you think these cars that my stepson's selling, do you think these people with 400 credit scores are going to keep their vehicles? They're probably going to lose them at some point. It is just the nature of having low credit. Sure, some of them will do it, but the same thing happens in the mortgage market. The marginal buyers are one that defaults first, and the banks know it. And so that's why financial conditions are tightening and why interest rates are falling. It's all right there. So now you know that the banks bamboozled the market. Oh, let me show you how they bamboozled them. Wait a minute. Here we go. Last week, they sold $8 billion of U.S. Treasury securities. Week ending October 2nd. Week ending October 2nd, right here. They sold into here. The market was buying them. They make interest rates go up, make you feel like quantitative easing is having an effect, and the Steve is wrong. I got more for you. Let's talk about the money supply. Get back into our normal scheme of things. This is data as of the end of last month when the federal government was racing toward the end of their fiscal budget and they needed to unwind or meet their budgets by selling. So I suspect the money supply will fall. You'll notice this rise in money supply has not turned into anything economically good. So we know that this increase is just government spending. 6-month rate of change increased to 4.27. 3-month rate of change increased to 2. Otherwise, if this was an economic expansion, you'd think this is great, but due to the monetary lag, it's not. Commercial industrial lending. You want to know what the big driver of interest rates in the economy? This. Growth rate dropped almost a full percentage point. Was it 6.1 or 1.5? It's now down to 5.1 from a year ago. The 6-month rate of change was up at a little over 0.5%. Bam, almost back at zero at 0.15. 3-month rate of change was plus 2.23, now negative 2.3. What does that mean in terms of interest rates? Well, I'm glad you asked. I'm going to show you. Here's the chart of commercial industrial lending. Let's go back. We'll zoom this in a little bit so you can maybe get a better picture on it. Here is the great financial crisis. This roughly right in here is the zero bound. You see the 3-month silver, 6-month orange, 12-month blue rate of change cross the zero bound. The 3-month always is going to cross first. Here you see and when did it start? It started going down in 2000 and then crossed by 2002. Here you see it started in 2008, 7? Don't know. And then you see, let's look at the next big move down here. Slowly came down starting back here in we'll just say 2015 and 2016. All right, now let's go back and look at bond market. No, that's not it. That's not it. Boom, bond market. Here, weekly chart. So bonds back in 2000, when commercial industrial lending started to fall, boom, interest rates went down. 2008, interest rates went down. 2015, it was late 2015, 2016, I think. Or was it here? Oh, here, 15. Boom, down. Now it's contracting. Interest rates are here on the long bond. What does that tell you? Interest rates are going to zero. It tells you everything. The financial system is contracting, and interest rates are already really low, and that means they're going lower. You can see it on the 10-year. Here it is. Boom, interest rates down. Where's 2008? Oh, right here. Boom, down. And then we get a better here. You see 2015 into 2016. Boom, down. All because, where's that chart? Commercial industrial lending. Because the big commercial industrial lending machine is falling apart. Just like it did here, except it's going to be worse. Just like it did here, just like it did here. And interest rates are going lower, not higher. There's so much evidence of this. It's not even funny. So we're going to look at that short-term volatility and see why it's not a big deal. Look at so here, what about consumers? They're driving a 3.74% annualized rate. Nothing. There's not huge demand, and the trend is down. And we're not in a recession. Here's why the stock market could drop 50%. Here we see S&P 500. Here is corporate profits. Everyone is so focused on the market's going higher, higher, higher. But look at this. Corporate profits started to flatten out and decline. Boom, there's your dot-com bubble. Corporate profits started to fall. There is your great financial crisis. And for the last 5 years, corporate profits have been flat. It's only a matter of time before they go down. If you're bullish on stocks, you need to believe that corporate profits somehow are going to massively increase. I don't know how, but that's what you have to believe, because otherwise you feel like this. Not like this, but look at that. If this started to fall, you could easily go from 3,000 to 1,500. There's your 50% cut in the market. The Fed is driving short-term rates higher. They're by enacting quantitative easing. We're going to talk about exactly what they're doing here momentarily. But you can see when they start driving short-term rates higher than long-term rates, boom, recession, boom, recession. You can guess what's coming. Even the New York Fed says their recession probability is just touched near 40%. Well, that was good enough for the great financial crisis, almost good enough for the dot-com bubble, and generally good for most recessions starting in the 80s on. And last, thanks to McClellan Financial Publications, as I pointed out, emerging markets are leading the S&P 500. So you can see when emerging markets start to go down and S&P's up, it corrects. Emerging markets go down, S&P's up, it corrects. Emerging markets go down, S&P goes up, it corrects. Emerging markets signal down move, S&P corrects. Emerging markets are moving down, S&P's head lower. Let's go look at what the Fed is up to. There we go. Sometimes this is harder than it looks. Okay. There we go. We are currently feeling the monetary lags going back to April of 2018, where we're doing $30 billion a month in quantitative tightening. We will feel $30 billion next month, $30 billion plus a rate hike. $30 billion is roughly equivalent to half a rate hike. So we'll have one rate hike over 2 months and then one rate hike in December that will effectively hit the economy. Then we hit the $40 billion for 3 months. Then we run the $50 billion that scales down. What happens is the effective federal funds rate due to all this gets up to a peak of 5.5%. This is a tightening that's coming. So here again, if you believe interest rates are going higher, the question is, where is the demand going to come from? You know, one of the best arguments I've heard is, hey, unemployment's at a 50-year low. It's the most lagged indicator the Fed uses. When people start losing their job, how can interest rates go up? How are they going to go get a house, buy a car that they can marginally afford now? They can't. So here's what's going to happen. The Fed is going to start October 15th, Tuesday, and they're going to buy $60 billion of short-term bonds, driving short-term interest rates up at a time when banks and securities dealers are desperate for short-term collateral. It's going to drop the federal funds rate from, say, 5 to 4.75 in April 2021. And they're going to continue doing this. So I did through the second quarter. So by the end of the second quarter, assuming they do no rate cuts, and I'm relatively sure they will, the effective federal funds rate will still be at roughly 7.5%, and that will be in December of 2021. The monetary lag, and that's assuming the monetary lags are not longer than 18 months by then, and they probably will be, but we don't know, so we'll hold it constant. So the tightening that we have not felt, we're right here. Where did I say we were? October. Here, boom. We're at 2.13 in terms of the effective federal funds rate. That is going to more than double between now and the next 16 months. How do interest rates go up when financial conditions are going to be tighter than they've ever been? All right, let me go load up the browser stuff. And if you're fully not convinced, see, quantitative easing, a $60 billion asset purchase every month is effectively a 0.25% rate cut. So we're going to have rate cut, rate cut, rate cut, rate cut. Well, here you see the federal funds rate in red. In purple is the 3-month treasuries, which actually feel the effect of the quantitative easing before the federal funds rate, because look, the difference between a rate cut and quantitative easing is identical. There's no difference. They're just called something different. They have the same exact effect. Remember, we had quantitative easing because the Fed couldn't materially take interest rates negative because they didn't think people would like it. So here you see, here's the 3-month treasury market going down. In 2008, financial crisis, so you have interest rates being cut to zero, and you have quantitative easing at mass scale. Look what happens to 10-year and 30-year, respectively blue and green, yields. They fall. And then here's that big waterfall move down. Here we are up here. We've got all this way down to go. Inside the plumbing, the NASDAQ McClellan Summation Index is showing a negative print. Financial conditions are continuing to show that they're tight. We've looked at that. We've looked at that chart. How about retail sales? They're coming out mid-next week. Do you think they're going to be great? Well, you can see I plotted 3-month treasury bills, interest rates against advanced retail sales, and you can see when interest rates go down, financial conditions tighten. And a good example here is you see this pop in retail sales, and then it started to fall because interest rates were falling. What do you think is going to happen? If retail sales fall, how do interest rates go up? They don't, not in our monetary system. Not how it works. Okay, I know I'm at the 30-minute mark, and I told you, I feel like I'm getting warmed up. I got a lot to talk about. Get some stuff cleared up. So do you really see that this recent move in bonds is not really a big deal? Yeah, I don't like. Look, do I like it any more than you do? No, I don't. But look, anybody who's ever invested money knows that there's a high probability that the market moves immediately against whatever you do just to make you look dumb. Just what it is. Anybody who's ever bought a stock knows that that is the way it generally goes. Sometimes you get lucky and it moves higher from there. Most of the time it goes down first and then it goes up. Remember, I was also been told I was very, very wrong about the bond market looking back here when it was up at 3%, and now, and what did it do? The long bond that I was right about had new all-time lows. So do you think I'm going to be right again? I just showed you all the data you could want. Okay, so let's break this down. Let's look at the long bonds. This is where we're heavily positioned. We know that the big banks sold some treasuries to get yields to go up. At the same time, they bought mortgages. So we know long-term rates are headed lower. And then today, it held right here nicely at this support level. It went up and got rejected back down. That's excellent news. Yeah, it crossed this 50-day moving average, not the end of the world. And let me show you why. And it's a little easier to show you on the 10-year treasury yields. And you see this triple bottom on 10-year. If you go buy a book on technical analysis, you don't find many comments about triple bottoms because triple bottoms usually break through, because at that point you've exhausted everybody that can sell. And what we're seeing right now in that little move right here, let me go back. This little move right here is pretty much all the sellers that are in the market. There's not many. They just don't have the ammunition. That ammunition isn't this, isn't that. But look at the difference here. Going back to 2012, where we had our first bottom, you can see it came down, made a bottom, bounced up, but the general trend was still lower. And then we had a series of where these are weekly higher highs, moving the market, moving it higher. I'll zoom it in a little bit. Now look here at this. It made a low, and then you have a series. It went up, and then it's making higher highs and higher lows. Look at here, made a bottom, did not make a higher high to here, did not make a higher high to here. If this was a panic move that interest rates were headed up, we at least need to see a weekly close over 1.9%. Instead, it found resistance right in this heavy chunk back in here. Looking at the 30-year bonds, they found resistance back to the first low, and right in the big chunk of the second low. If the banks are buying bonds, how do interest rates go up? I mean, do you know people that are going to buy billions and billions of dollars a week? Nope. Let's look at the S&P 500, shot higher and then had a reversal candle going into late, right after the announcement, 20 minutes before close. The market was fooled just like everyone else, thinking it was going to be a big trade deal. It wasn't. Should set the stage for stock prices to go down. Even volatility went lower, but saw volume as people were most likely re-hedging against the news late trading. And we can go and look and say, oh yeah, a bunch of volume here, as people going like, uh-oh, maybe I was on the wrong side of this after all. And here's some evidence. Even ag commodities that had a nice up day did not like shoot through the roof. Now the weather that's coming is going to be bad news. The big cold front that I've talked about is going to hit tonight and this weekend. It takes 2 hours of freezing temperatures to kill a crop, to completely stop the growing. There's supposed to be high winds and freezing temperatures. And there's a second storm coming at the end of the month. So what doesn't get it this time, probably getting next time. These crops are not ready to be harvested yet. And if this is a bad freeze, party's over. This deal with China doesn't matter. Let's see. What else do we need to look at? I think how long have we been going here? 33 minutes. Let's save stuff for Monday. The bond market is closed on Monday for Columbus Day, so we won't be able to look at bonds, but we can get a good idea of where bonds are headed because we know the banks are buying. We know financial conditions are tightening. Next week, we get mortgage applications. Remember, we've seen mortgage applications fall until we got to that low. I'm just looking at my neighborhood and seeing homes that were for sale getting pulled off the market that are appropriately priced sell. I'm seeing my neighbor's house who is, I talked to a realtor, one of my friends, he knows who he is. I had lunch with him. He's watching. He knows who I'm talking about. He told me, man, if you got a house under $300,000, it sells like in a week. My neighbor's house priced right under $300,000, nice home, well maintained, nothing, not a blip. I think he's had 2 or 3 showings, nothing. So lower interest rates briefly help the mortgage market, but we'll be interested to see what mortgage applications are next week, retail sales. Again, the show isn't over here for bonds because the economy is slowing big time. Interest rates probably headed to zero, folks. So forget the short-term volatility. Just hang tight. Thanks. things will get better. I'm Steve Van Metre. I'll see you Monday. Bye now.